The Trade is brought to you by Vantage Markets, delivering one of Australia's most trusted and award-winning trading experiences. Explore smart trading at vantagemarkets.com.au.
Welcome to The Trade on this Friday. Well, let's take a brief look at the headlines. Federal Appeals Court temporarily reinstating the most sweeping of President Trump's tariffs a day after a trade court, international trade court, ruled that the president had exceeded his authority in imposing those duties and ordered an immediate block on them. Meanwhile, President Trump has called Federal Reserve Chair Jerome Powell to the White House for their first face-to-face meeting since he took office, and telling the central bank chief he's making a mistake by not lowering interest rates. And even as NVIDIA reported another blockbuster quarter of 69% sales growth, the maker of AI chips warning of more emerging risks to its business due to the tech conflict between the US and China. And core inflation in Japan's capital hit 3.6% in the year to May. Data showing it's marking a more than two-year high is a sign of persistent increases in food costs will keep the central bank under pressure to hike interest rates further. Let's get into how this is playing out on the charts. Ilya Spivak joining us from Tasty Live. Ilya, welcome back. Good to see you. Plenty of movement, of course, we're seeing in regards to what is looming as a court battle now over Trump's tariffs. How do you see this playing out? In particular, I guess it's affecting the US dollar.
Absolutely. Very good to be with you again, Andrew. I think when you look at the way the markets responded to all of this over the past 24 hours or so, you get this very clear sense when the news initially hit that the court has blocked some of these tariffs, that this is a good thing, that this is positive for risk sentiment. Stocks rally, the dollar rallies, bonds come off as yields go up because you get this kind of a pro-growth sense that these trade barriers won't hold up. But then, of course, you get the reversal. And so here we have a chart of the euro just to get a sense of the dollar's overall direction. And you see that at first the euro sells off, the dollar comes down to that support level just above 112, then recoils and ends up with a loss of about 0.5%. And it does look like the dollar is on track to weaken further. We have that pullback from 116 to about 111, 110.90 there. And it looks like that pullback has now run its course and we're back into a bullish mode for the euro and by extension, a bearish one for the dollar, 114.34 there, the initial barrier. If we can take that out, the next one looks to be that high at 116.13.
You mentioned those treasury yields. What are we seeing on that front at the moment? I mean, a lot of movement there, particularly in regard to Trump's so-called big, beautiful bill, but there's also the backdrop of obviously trade tension.
Absolutely. Well, I think the reason that the markets had this seesaw in response to this news is, of course, initially they sort of reasoned, okay, this is something that's growth positive. And indeed, we saw yields go up, bonds spiked lower. We see that on the latest candle here for the 30-year rate. But then, of course, they rethought. And just as they rethought on the dollar, they rethought on the bonds. And the bonds ultimately ended up with a meaningful rally. I think the logic there is the administration is going to fight this in court. They have other avenues that they can use to levy tariffs, but they're more cumbersome and they will take longer. And we've probably pushed this out now some months, which of course prolongs uncertainty at a time when, as you mentioned in your lead-in, the Fed is resistant to cut rates, and economic data, including the revised US GDP numbers, suggest consumers are flailing. So you have recession risk, a slow Fed, and more uncertainty. And I think what that has translated into for the markets is recession risk, but with a Fed that's going to wait for the downturn to happen before it acts, so it really knows that it doesn't have to worry about uncorking inflation expectations. So we have a kind of cut more later sort of dynamic here. I think that's likely to continue to boost the long end of the curve here. If we can get north of this immediate resistance around 113, it looks like we have room to keep going higher as markets bake in more rate cuts just for next year as opposed to this year.
Now, earlier, we have in fact had a revision of GDP growth in the States, but also a bit of softness there emerging in jobs, which I guess, once again, raising the prospect, is recession possible?
I don't just think it's possible. I think it's the likely outcome here because what we're seeing is we just saw data showing us, of course, through these GDP numbers that, yes, we had a massive distortion from imports. We had a massive distortion in investments because, of course, of the building up of inventories. And all of that is front running the tariffs. But when you look at the bottom line, these are all relatively small contributions to GDP, and it's the big swings that make them important. The bigger issue is consumption was the weakest in almost 2 years. The reference point there, the second quarter of 2023, and that's 68.5% of GDP. We saw that although in the PPI data, we see businesses are eating these inflation costs from the tariffs and not passing them on to consumers, consumers still didn't show up in April. And the consumer confidence numbers for May look relatively downbeat. So we probably have the ingredients for another weak consumption quarter in the second quarter. And without consumption, there is no U.S. growth at a time when China is anemic and the Eurozone is anemic. And all three together is 58% of global GDP before you count all of the other economies that are vendors and depend on those three for demand. So the ingredients for a global recession are here. And if the Fed is not going to step up and they're going to wait longer, well, then you have a situation where it's not just a U.S. recession, it's a global one.
So, with the prospect of recession then, you'll see bonds rise, also pointing out, obviously, gold. That would be a boost for the precious metal, pressure on the US dollar. What about stocks?
Well, I think stocks have had obviously a massive run off those panic April lows when it looked like the U.S. was going to try to surgically remove itself from the global financial system, of which it is the bedrock. Obviously, the dollar and the treasury bond are absolutely indispensable in global commerce and global finance. Once that risk abated, as it became thankfully clear that there really is no alternative, even if the U.S. is intent on self-harm, then we saw this unclenching. We saw the administration was somewhat amenable to market discipline, but we see here over the past 24 hours, we spike to a 2-month high, but then we can't hold it and the whole thing falls apart. I think largely around this uncertainty around the tariffs with everything else that's going on. And the prolonged uncertainty, the recession risk, the slow Fed, all of that bodes ill for stocks. And I think here, if you can get through this support area around 57.24, 58.09, well, then you're looking for significant losses to follow. I think this sort of sentiment-driven, we're away from the worst kind of a rally is probably running out of steam.
Ilya, great, you can talk us through those charts. Thanks for joining us on Tasty Live.
Very good to be here.
And that is the trade.
The Trade was brought to you by Vantage Markets, delivering one of Australia's most trusted and award-winning trading experiences. Explore smart trading at vantagemarkets.com.au.